Today, what I'm going to break down for you is how you can pay $0 in taxes legally. And that's all thanks to real estate. When I first started working, I remember looking at my paycheck and, like many of you guys, thinking, where the hell did all my money go? I know I worked incredibly hard. I know I put in tons of hours, at least 40, right? I was doing everything right. And still, a huge chunk of my paycheck was gone before I even touched it. So I was making, let's say, 5,000. By the time I see the paycheck, I've got $3,000 or $4,000 left over. Where did all my freaking money go? Obviously, as you all know, it goes to taxes. So fast forward a few years, I started investing in real estate. 2020, I bought my first property, but then something didn't start making sense for me. I was still paying a lot of taxes on my income I was making from my job, but now I was making even more money. I was literally making more money through my property, but I was paying less in taxes overall. This was insane to me. This didn't make a lot of sense. Like I said, I was making strong cash flow from my rental. My net worth was growing. My properties were appreciating in value. My tenants were the ones that were actually paying down my debts for me. But my tax bill on my real estate was basically $0. That's when it clicked for me. That's when I started understanding real estate is so much more than just the cash flow. The wealthy are playing a completely different game than us. Or honestly, you know what? The wealthy are playing the exact same game as us, right? They're not playing a different game at all. What they're doing is they're following a completely different rule book. What they're doing is they understand owning assets, tax advantage assets, is just as important, if not more important, than the amount of money that you're making. And real estate is one of the biggest advantages in that rule book. So during today's training, I'm going to show you how real estate investors legally reduce or eliminate all their taxes, how you can even use your real estate losses to offset any W-2 or job income, and how you can build wealth while keeping more of what you're making, right? So you're building wealth, building cash flow, building your freedom, but actually keeping more of that money that you're working so hard for. So let's break it down. The foundation, right? You got to understand the rules first and foremost. It doesn't do a lot of good if you don't understand the rules behind the tax savings. So the first thing you need to understand is that not all income is treated the same. There's really three types of core income. There's active income. Think of your job, right? You go and you work and you make some money, whether you're salaried, you're hourly, whatever. You go, you trade your time, you make money. That is active income. There is portfolio income. So you take that savings that you're making and you're investing in things like stocks, or you're investing in gold or whatever other asset like that. And when you sell those, that you're getting income from that, right? You're selling it, you're getting income from that. That's another one. That's portfolio income. Invest in assets, sell them, you keep the difference. And there's passive income. So same, you got your savings, you're buying real estate, but real estate has a massive tax advantage. It's considered passive income. And I'm going to break down what that means, especially what that means for taxes. The most important thing to understand is between active income, portfolio income, and passive income, right? Your job, stocks, and real estate, each one of those is taxed very differently. To make it very simple, let's say you make $100,000 at your job. You might keep around $85,000 of that just after paying your federal taxes. That doesn't account for all the other things you're going to get hit with your job income, all the other deductions. But just from your federal taxes, you might keep around $85,000. Well, let's say you make $100,000 in stocks. So you have a $200,000 portfolio that costs you $100,000 to invest, right? So you're selling the difference, you're making the difference, that $100,000. Of that $100,000 that you made, you might keep $83,000 to $92,000 of that, depending on how quickly you sell it. Basically, if you hold a stock for over a year, it's better tax benefits. Under a year, you pay more taxes. But that $100,000 in gains, right, what you're making from your stocks, you might only keep $83,000 to $92,000 of that. Through real estate, if you make $100,000 in real estate through your cash flow, you're often keeping most, if not 100% of that with no tax hit at all. And in many cases, you can even reduce the taxes that you are paying on that job income. So very simple, right? If you make $100,000 at your job, you might keep around $85,000. If you make $100,000 through stocks, you might keep $83,000 to $92,000. If you make $100,000 through real estate, you actually keep the $100,000 while also all those wealth building benefits. This is the key. Real estate doesn't just make you money, it protects your money. It's one thing to make $100,000, like we went through those 3 examples. It's just as if not more important, how much of that $100,000, well, it's more important, how much of that $100,000 you're actually keeping. So how is this possible? What even makes this work? Well, the core strategy here, the core tax benefit from real estate investing is depreciation. This is where everything changes between owning real estate relative to any other asset or any active income that you're making through a job. This depreciation, basically, the IRS allows you to write off your property over time. Even though your properties are going up in value, the IRS lets you say that your properties are losing value over time and you get a tax benefit for that. If that isn't hitting you yet, it probably will when I give you some of these examples. So just to clarify again, your property is going up in value. You bought it for $400,000. It's now worth $500,000, right? 5 years down the line, whatever. It's worth more money, but the IRS saying you bought that thing for $400,000. Well, we're going to give you tax deductions every single year as if that property is losing value, and you get to write off your income earned from real estate. Let me give you a very simple example. Let's say you make $20,000 in cash flow from real estate, right? Your income minus your expenses for your rental property, what's left over, your cash flow, your profit is $20,000. Well, if you get $25,000 in depreciation tax benefits from your property, on paper, you just lost $5,000, right? 20,000 cash flow, right? That's positive, minus $25,000 in depreciation, the tax benefits, you lost $500,000, or you lost $5,000 on paper. In reality, you made the $20,000. You get to keep that $20,000. So you are getting paid that $20,000, but the IRS sees a loss because of the depreciation that's offsetting that income. That's the core idea of how you keep some, or like most, if not all of your income generated through real estate investments. This is whether it's 20,000, you have 5 of these properties, it's 100,000, you have 10, 20, 30, however many of these you have, that's the same core idea. Your cash flow, your profits that you actually get to keep and use are offset by your paper losses through depreciation. Now let me give you a more real number with actual, or a more real example with actual numbers, and you'll also see how this is broken down. So in the future, you're going to see, I'm going to, once this is not a live video, I'm going to have the slides to show you how this actually works. So now let's make this real with actual numbers. Let's say you go ahead and buy a property worth $400,000. The way you get tax benefits, or the way depreciation is calculated, is roughly, they say of that $400,000, $20,000 of the value is for the land itself. That's not depreciable. The land doesn't lose value. The property does, the building does. So that 80% of the $400,000, that $320,000 is what you can depreciate. The IRS lets you, or the IRS basically says that that $320,000 is going to go to zero over 27 and a half years. So that $320,000 divided by 27 and a half is how much tax benefit you get per year. That gives you around $11,600 per year in depreciation for that one property for the next 27 and a half years. So let's say that property makes you around $1,000 per month in cash flow. By the end of the year, right, that's your profit. By the end of the year, that's $12,000 of cash flow, $12,000 of profit, $12,000 of money you get to use on whatever you want. But that $12,000 of cash flow is not, it's not, you're not paying taxes on it. Why? Because you have that $11,600 of property depreciation. The property is losing value, even though it's going up in value, even though you're building wealth through equity, right? From appreciation, your tenants are paying down your debts. Your property is losing $11,600 of value on paper, according to the IRS. So that offsets your $12,000 of cash flow. So in reality, the IRS only sees about $400 of income. So you're keeping $12,000, right? That's how much you're actually making in profit because of the depreciation of $11,600. you're really only reporting $400 of income. So you're basically paying zero taxes. You're paying taxes on virtually none of the actual income that you generated. If this is resonating with you, I need you to let me know this is making sense to you, because I need to understand this makes sense to you. If I need to break it down in more detail, understanding that in the near future, I will combine some slides and some actual visual examples, but I want to see where you guys are at, because this to me is so obvious at this point. I've been doing it for so long. I want to make sure that you guys understand it. And we're hitting on the biggest tax benefit of real estate right now, but we are not even close to hitting on all the major tax benefits associated with real estate. We're literally just scratching the surface. So let's take this one step further, because investors, especially like myself, don't stop there. They accelerate the benefits. I make sure to accelerate the benefits. So something you can do in real estate is you can conduct a cost segregation study. Basically, you are breaking down the property, not just saying, hey, it's an 80% tax benefit of the property, but you're breaking it down. You're getting an engineered study. It's a couple hundred to a couple $1,000s, depending on the property and all that. They conduct a cost segregation study. And what they're doing is they're saying, hey, what parts of this property are actually going to degrade faster, depreciate faster than other components? Roughly 25% of that building is going to qualify for faster depreciation. That means of that $400,000, right, or the $320,000 that's left over, approximately $80,000 is going to be a write-off for you in year one. Does that make sense? You're breaking down the depreciation, you're breaking down the building into its smaller components by doing a cost segregation study, and you are accelerating, you are taking the tax benefits even quicker. So in the first example, you got $11,600 of depreciation that first year, making your cash flow virtually tax-free. Well, in this example, when you're doing the cost segregation and accelerating some of the depreciation, you're getting, instead of $11,600, you're getting $80,000 of tax benefits in year one. So that same deal that made you $12,000 of cash flow, well, now you get $80,000 to write off through that accelerated depreciation, that paper loss. So now on paper, even though you're making that $12,000 or however much cash flow you're making, you're showing a $60,000 to $70,000 loss on paper. Even though you made money, you got to keep all of the income, all of the cash flow, you're showing that you made $60,000+ of loss. Once again, the crazy part about all this is not only are you generating the cash flow, you're keeping all of it, you get excess losses, you get more losses that can be carried over to future years, or you can utilize it in a variety of other ways, which I'll talk about. This is all happening at the exact same time that your tenants are paying down your loan, your property is increasing in value, both of those building your equity, both of those building your wealth. You are collecting cash flow, and because of the way that it's set up, the IRS sees a loss. So you're keeping all of that cash flow, and even further, you're getting even more tax benefits for this property, for other properties, or other ways that you can utilize that. So you're building wealth in multiple ways while showing little to no income. This example, zero income, if not massive losses. And this is why real estate investors can make money and still pay almost nothing in taxes. This is why I can make hundreds of thousands of dollars a year in cash flow profits. However, I pay zero in taxes because my paper losses, my depreciation is greater than what I'm generating in cash flow. This is just one benefit, because on top of depreciation, there's other tax benefits to owning real estate. When you are paying the mortgage, right, the loan payment, a portion of that is towards paying down the debt, the principal, right, building your net worth. Another part of that is the interest. Well, mortgage interest is a tax deduction. Once again, remember, your tenants are paying you income. You're using that to cover your expenses. One of the biggest expenses is the mortgage payment. So your tenants are the ones paying your mortgages down for you. They're also getting you a bunch of tax benefits through the depreciation and through the interest deduction. And whatever is left over is your cash flow. Your income minus your expenses is your cash flow, which is all tax-free. It's literally insane. When you buy a property, those closing costs are also write-offs, right? Some of it is written off immediately. Some of it is written off over time, similarly to your property depreciation. When you're doing renovations to your property, some of that is expensed right away, and then some of that is a capital expenditure. It is depreciated over a longer period of time, either instant tax benefits or tax benefits over a longer period of time. All these other operating expenses for your property, your business, are also tax deductions. We'll touch on those more later, but I want you to understand depreciation, although it's the major tax benefit, it's not the only tax benefit that comes from real estate. The crazy part here is you got to understand this. Depreciation alone can wipe out your income, right? I just gave you that example. Everything else is extra, and it's really up to you how you decide to utilize that. Whether you carry it forward for future years, whether you use it to offset other types of income if you qualify. There's a lot of other ways to leverage those benefits. This really is a cheat code, though. There's no way, there's virtually no way, like no other way that I can think of, maybe someone else can, where you're actually getting paid, you're making money, and you're building wealth, but you're showing a loss. Not only are you not paying taxes, you're showing a loss, which is insane. You're making money, but you're showing a loss through the real estate benefits. This is why real estate investing is so unfair compared to other investing strategies, right? This is why when they say it's better to be a business owner than an employee because you get tax write-offs. Well, a business owner does not get nearly the same level of benefits as a real estate owner, which is also a business, but you have the massive depreciation from real estate, and sometimes you're putting a very small percentage of money down to actually own that asset and to get those benefits, all the tax benefits associated with it. So let's supercharge it. We can take it even further. Like I mentioned, there's the cost segregation where, some people might think splitting your tax benefits on a property over 27.5 years might be too slow. Well, it doesn't have to be. As I mentioned, you get the cost segregation. You can accelerate that. There's also bonus depreciation. This pulls years of deductions. So instead of doing this over 27.5 years, you're doing this over 5 years, right? So combining the cost segregation to get the bonus accelerated depreciation, this is pulling all those tax benefits way more upfront. So as that was that example that I gave you of the $80,000. So instead of that $10,000 per year of tax benefits, we'll say, you might get $80,000 or $100,000 or even more in just year one. This creates a massive paper loss, and that loss becomes extremely valuable. As I mentioned, there's a variety of ways to use that, whether you decide to carry it over for future years, or depending on if you qualify, you can literally offset your W-2 income or your other active income sources or your portfolio income. So you can use it to offset money that you're making through a job, through consulting, through whatever, that's if you qualify, or you can utilize it to offset your portfolio income, right? You sell stocks like I do sometimes, and my real estate losses mean I get to pay no taxes on those stock losses. So let's connect it, because this is what a lot of you guys want, and this is an ultimate cheat code. How do I reduce my job taxes? This is so massively beneficial, especially in your building phase of your portfolio, right? Earlier years, I mean, even later, obviously, but in the earlier years where you're using your job to build your portfolio to become financially free. Well, if you get to keep more of your money earned from real estate and from your job, whether it's $5, $10, $20, $30, $40,000 extra, that's more money to use in your investing journey, which then gets you more benefits. It's this crazy loop that keeps making it easier and better and faster to achieve your end goal of financial freedom through real estate. Or really financial freedom through anything, but real estate is the one that gives you these benefits. So to be a real estate professional, I'm not going to go into all the details right here, but I can drop it. If you're not familiar with my Real Estate Freedom Roadmap community, it's a free community, and I can drop basically what my CPA has provided, and it's a breakdown of what it takes to qualify as a real estate professional. So I'll drop that link here. I'll drop that link. I just dropped that link there. Oh, I got to do it for my Instagram friends because not everyone goes to YouTube. I dropped that link in both places so you can get that. I'll give you guys that. So what it takes to qualify as a real estate professional. But basically, if you're making real estate your main focus, right? It's your main focus. It's where you're earning the majority of your income or you're spending the majority of your time, right? And you document that time that you're spending in real estate. You get to utilize those losses from real estate to offset all types of income, right? The tax benefits, or the W-2 active income, consulting income, whatever, or the portfolio income. So not just the real estate income, the passive income that you get to offset, but you get to expand that to all of your other active income sources or portfolio income sources. The tricky part is this is pretty hard for people to qualify for when you are actively working a job, right? When you're actively working a job, it's hard to say real estate is your main focus because you can't really spend 40 hours in one workplace and then 40 hours in real estate and then document that effectively, and the IRS is cool with that. A major cheat code here is that if you are married, one partner, as long as one partner qualifies as a real estate professional, right? You maintain real estate professional status. Doesn't mean being a landlord. That means investing in real estate, or all those things, wholesaling or fix and flipping, whatever real estate related. There's a lot of things that qualify for it. As long as one partner is a real estate professional, you get to offset the entire household income through this. So one partner being a real estate professional qualifies the married couple to maintain real estate professional status and utilize any real estate losses, any passive losses, those accelerated losses, standard deduction losses, whatever, to offset all sources of income. This is a major cheat code, and this is how my wife and I decided that she would retire from the W-2. She was like 26, 27 years old, because in reality, we were going to be making the same, if not more money at the end of the day from her working in real estate as her full-time job, as opposed to her going and working for someone else and earning active income, because the tax savings that we were going to get from this benefit from the real estate portfolio, offsetting all the other active income sources, was equal to, if not greater than, how much money she would be taking home after all the tax hits. Does that make sense? So the tax savings that we were going to get was going to offset or be more of a value than the amount of money that she was making at her job. And on top of that, she gets a way better quality of life. She was her own boss, right? All that stuff, until later I quit my W-2 and then I'm the real estate professional status now, or I maintain real estate professional status. But during that phase, even as I was making a little over 6 figures working, in California as a government employee after getting out of the military, we were able to offset all of my income through my W-2, all 6 figures of income, from my wife's losses, or from my wife qualifying as a real estate professional from our real estate losses. If I lost you here, I'm sorry. This is why I'll have a visual for you guys to show the variety of ways. But the main point here is either you can be a real estate professional and offset your active income, right? Let's say wholesaling is your active income, which is real estate related. You're making 6 figures or more, whatever, through wholesaling or bird dogging or fix and flipping or whatever. But you also have real estate properties. You can utilize those real estate properties, the losses from those rentals, to offset all of your active income through those real estate activities, even though they're active income. Even though real estate like rentals are passive income, passive losses, they can offset your active income generated through wholesaling, bird dogging, fix and flipping, capital connecting, whatever you're doing in the real estate space. Well, it can also offset your W-2 income. It's much harder to qualify if you have a full-time W-2. It's much harder to qualify. But the major cheat code is if you are a married couple, if one single partner qualifies, the entire household qualifies. That was a huge revelation, huge cheat code. Well, there's another one that a lot more people understand, and why a lot of people get into short-term rentals, which is called the short-term rental tax loophole. This is another game changer because the criteria for qualifying for this is much lower than real estate professional status. Basically, real estate professional status, you have to show that 51% of your time and income is earned through real estate, right? So the majority of your income and time is dedicated towards real estate as opposed to other income sources. And you have to log around 760 hours a year. In the grand scheme of things, that's not a ton, but if you're really doing this thing, it's not a lot. You get that very easily. But the short-term rental tax loophole, there's other qualifications, but it basically means that with 120 hours instead, and even if you have a full-time W-2, you can still qualify for the same level of benefits. If your property qualifies as a short-term rental, if you're the one involved with managing it, and as I mentioned, if you're able to log enough hours like the 120 or whatever hours, a much easier threshold, then you can use those losses without quitting your job. That's why you see a lot of people utilize short-term rentals for the major tax benefits, especially high income earners, because they're really not even doing it for the cash flow benefits, right? They're even willing sometimes to take a loss in cash flow benefits. However, that means they're saving a ton of money in regards to what they would be paying in taxes. One simple example is at the end of last year, I had a friend, an investor, one of my capital partners as well. He had $300,000 tax liability he was going to have to pay. He was going to have to pay $300,000 of taxes because this guy makes a lot of money. Well, he makes the majority of his money in the real estate space. Well, he makes a lot of money through e-commerce and like that kind of stuff. His wife is a real estate professional, so they qualify for real estate professional status as a married couple. We took that $300,000. He used a portion of that to buy a property, so $100,000 to buy a property, did the cost segregation, did the accelerated depreciation, did everything to accelerate it. In that $300,000 he was supposed to give to the IRS, he used $100,000 of that to buy and own a property that's going to make him money, build him wealth, do all that other good stuff. And he got to keep that extra $200,000 because this was a much more expensive property and had a lot of tax benefits, especially when accelerated. It's a major cheat code if you understand how taxes work for real estate. Depreciation being the number one key factor, and then understanding, can you qualify not just to offset your real estate income, right? Offset that, any tax associated with that, but then offset any other active income source that you have. That's the real cheat code. Very simply, right? You can make $100,000 at your job, but you can create $100,000 in depreciation, paper losses, according to the IRS. And then that allows you to significantly reduce your taxes and not pay any taxes at all. It's how I've not had to pay taxes for the last 4, 5, 6 years almost. So after my first property, the second property already got me to the point in which we didn't have to pay any more taxes. This is one of the most powerful strategies because I mentioned, it's not just that you get to keep more of your real estate income, but if you get to keep more of your overall income and you have more paper losses that carry over, you get more money today to be able to reinvest into things and build this portfolio more quickly. The more you buy, the more you save, the more money you have to buy to save, yada, yada, whatever. Or if you do what I do, I'm a super investor, right? So I raise the money to buy my deals. So it's not even earning money to save money, to invest money. The money that I'm saving, I get to keep and do whatever I want with it. And then I get to raise the money to buy more real estate, which gets me more tax benefits and just feeds into this as well. Whether it's your own money or you're raising money to buy it, either way, you're getting the tax benefits and you get to save more of the money that you're earning on those assets, but also through active income or portfolio income. So then how are you building wealth without paying taxes? So we'll just zoom out for a second. Even without these advanced strategies, real estate still wins. Why? Because you're not paying taxes on any appreciation for a property until you sell. So as your property is going up in value, right? As your loan amount is going down, your tenants are paying on your debt, your property is going up over value while you're generating cash flow, while your debts are getting paid down, while you get these massive tax benefits, you're not taxed on any growth through a real estate property. So as the property goes from $300,000 to $400,000 to $500,000, or one of my luxury San Diego properties went from $1.75 million to $2.2 million. Well, that extra gain of equity, that's not taxed. You're not taxed on that growth unless you choose to sell that property. Well, another crazy tax benefit is that you can access that money a couple of different ways without paying any taxes. So you get to save money for your cash flow, right? You're not paying taxes on that cash flow that you're generating because of depreciation. You might even have excess depreciation that's offsetting your active income. While as your properties are increasing in value, the one time you might have to pay taxes when you sell the property or you want to pull money out from the property. Well, there's a variety of ways to either pull money out or utilize that money with tax advantages. You don't even have to sell a property to access that money, that $500,000 of new equity. I can access that without having to sell the property or pay any taxes at all. This is the borrow strategy. You hear a lot of people talk about the borrow until you die strategy, right? This is what the wealthy do. This is a real benefit in real estate, but also when you have stock portfolios, it's very analogous to that as well. This is one of the biggest advantages, and very few people even understand it, especially how the wealth building, the equity plays such a massive role in your long-term objectives, right? You need the cash flow to be financially free as quickly as possible. But then the wealth that you're building, the equity that you're building, allows you to further benefit massively as a result. And the problem is most people don't understand this. Loans that you take out are not taxable. Let me say that again, and I'll explain what I'm talking about. Loans that you take out against your assets are not taxable. Borrowed money is not income. If it's not income, it is not taxed. Borrowed money you're borrowing against your assets as they're building in value, building wealth. As you borrow money against that, that is not income. That is a loan, and that is not taxed. You hear of Jeff Bezos, Elon Musk, whatever. They have these huge stock portfolios and they pay no taxes because they're never selling those assets. They're just taking loans out against them. It's the same thing for real estate, right? You can do a refinance, get a HELOC, pull money out from that asset and not pay any taxes, because really all you're doing is taking an additional loan out, even though you've got all these tax advantages throughout this entire period and your tenants are paying down your debts. They're the ones building your equity. They're the ones doing all of this stuff, or they're the ones allowing you to build all this and then take further income from your assets. Well, income, further extract the capital that you've built, the wealth that you've built on top of the cash flow, and pay no tax on it. Here's exactly how most investors use this. You buy a property, $300,000. It goes up in value, $500,000. Your tenants are the ones paying down your loan. So not only is the property started at $300,000, now it's worth $500,000, $200,000 in new equity. Well, that $300,000 loan, your tenants are paying down that loan. So now your $300,000 debt is $200,000, right? So your equity is the property value, which is now $500,000, minus the $200,000 current debt. So it's $300,000 of equity, 500 minus $200,000. That $300,000 is your equity. Well, instead of selling the property, instead of selling it, you can keep the property, go to a bank, do a cash out refinance, do a HELOC. You can even cross collateralize, which is more advanced. We're not going to worry about that. But you can pull money out from that asset and they'll give you cash. $50K, $100K, $200K. It just depends on the product that you're using. That money hits your account. That money literally goes into your bank account and it's all tax-free. Why? Because it's not income. It's a loan. It is not income. It's a loan. Okay, well, for that, you're going to need to leave some equity. So $500,000 value, right? They won't give you a, I got to kind of do the math on this. They won't give you a loan for $500,000 minus the 200, right? They're not going to give you that 300,000. They'll usually give you a loan up to 75% of the property value. So 0.75 times, that's $375,000. If your debt is $200,000, the difference is $175,000 that can be pulled out completely tax-free. You still have 25% equity in your property, so you have a very good equity position. You're probably still cash flowing pretty significantly, and you're pulling out that $175,000 tax-free. Now you get to restart the benefit of your tenants paying down your debts, the interest deductions that are associated with it, and you have that money to do whatever you want with it. Whether you choose to live off of it, whether you choose to reinvest it into other assets, whatever, you can do whatever you want with that loan that is tax-free. But this is insane. Like I said, you still own the asset is still producing you income, your tenants are still paying down the loan, and the new interest is also tax deductible. So think about what is happening here. You are pulling out cash and there are no taxes associated with that. You get to keep the asset. You increase your deductions, right? Your tax benefits. You continue building wealth. This is the shift that most people never see. They don't think about real estate their real estate investing journey long enough to understand this is another major benefit. It's not just the year one cash flow. It's not just the year one appreciation or debt pay down or the tax benefits. It's as you continue to own these assets, your tenants continue to pay down your debts, your properties continue to appreciate in value. You pay no taxes during this entire process. You also pay no taxes when you tap into that equity, that wealth that your tenants have helped you build. A lot of people will think, okay, well, let me sell this property instead. Let me pay taxes on that money, right? If you sold the $500,000 property for $500,000, you had $200,000 of debt. Well, you have that $300,000 of income that comes in, and you have to pay taxes on that, and you just reset and do whatever you want. Well, wealthy investors understand it's better tax-wise to borrow instead of selling. Like I said, this is the core idea of behind the borrow until you die strategy. You keep your assets, you borrow against them, you scale your portfolio, and you avoid triggering taxes along the way. Well, what if I told you, even when you sell a property, you don't have to pay taxes? There's another literal in the rule books, in the tax rule books, in the IRS codes that allows you to pay literally zero taxes, even if you do choose to sell. So you're paying no taxes with the cash flow. You might be able to offset your W-2 income. You can borrow money against your assets, extract some of the equity and pay no taxes. Or even if you choose to sell that asset, realize on that whole $300,000 benefit, right? Not the 75% loan to value minus whatever, which is that $175,000. If you wanted that full $300,000 today to be able to utilize it, well, the IRS gives you a tax code for that as well, which is what a 1031 exchange is. So even when investors do sell, a lot of them who understand this stuff are not just taking that tax hit. They are using the 1031, they're using a 1031 exchange. They are selling property A, right? Let's say that for that $300,000 profit, instead of paying taxes on that, they are just buying another property with that equity, allowing them to get into another asset, typically a bigger property, a better property than the original one, typically one that's going to generate you more money, have more equity built in. Typically, you're doing it to get a better property, right? Or you're doing it to get multiple properties, and you get to defer all the taxes. So basically, the 1031 exchange allows you to sell your property, get the full profits, and then utilize that to buy these other assets if you choose to. There are no capital gains on that because of the 1031 exchange, no depreciation recapture. You roll everything forward into this new asset. Many investors follow this process, right? If they're not doing well, actually you could combine the two, which is kind of the crazy part, right? You can either buy a property, hold it, let it build wealth, and then refinance, pull money out, tax-free, and continue owning that asset. Or you can buy it, hold it, refinance, pull that money out tax-free, and then now sell it. So you got the $175,000 tax-free. Now you're selling the property for the remaining $125,000, whatever it is in equity, 1031 exchanging that $125,000 into another asset while also pulling the $175,000 tax-free. You just continue repeating the cycle. This is how portfolios scale, especially without those constant tax hits, is that you keep more of your money throughout the entire journey, continue building your portfolio, pulling money out tax-free, and or buying bigger, better, or more assets, all tax-free. It's insane that this is legal. I don't even, as an engineer, as someone who really likes to get into the weeds of this kind of stuff, and someone who's, I'm a capitalist, don't get me wrong. I'm an absolute capitalist. I served our country, the United States of America, as a thank you for being born in this amazing country. First person in my entire lineage to ever be born in this country. I graduated as an engineer. I chose to serve our country as a thank you for being born here. I'm a capitalist to the core, but I'm also very much a compassionate capitalist. I think it's kind of messed up that we as real estate investors, business owners, whoever, get all these tax benefits where other people who are primarily workers and or those investing in stocks that the way it's advised are not getting these same benefits. I wish they got more of these benefits. However, as a capitalist, if these benefits are there and they exist, it'd be irresponsible, if not even potentially immoral, to not take advantage of these tax benefits. And take advantage that has a negative connotation, to not utilize the tax code as is constructed and expected to be used. Why? Because as a compassionate capitalist, I can then take that excess money. I can then provide other people like you guys better education, better support on your journeys, and use that excess capital now to then invest in the causes that I care about. But if I just gave it to the government, and didn't follow the tax code the way that it's literally constructed, if I didn't do that, then I'm basically, my charity is to the government, and then it's how they choose to use it. And I'm so sick and tired of the way the damn government uses our money, uses it for unnecessary wars. Like, I don't want to pay for bombs for other countries. I don't want to do that. I want our money to go towards our people. If that means healthcare so people are not dying, if that means children in our country are not hungry, if that means veterans, right, people who served our country are taken care of, I would much rather have our money go towards protecting our people, taking care of our citizens, taking care of all the amazing people that we have in this country, not being spent on other countries, not being spent on foreign wars, not being spent to enrich the wealthiest primarily through wars. I would much rather have our money, if I am paying taxes, benefit our country. Well, because it's not doing that, I take it upon myself to understand these tax rules and leverage them to the best of my ability to then have more income to then donate and support the cause that I care about. It's as simple as that. You can be capitalist of the core and understand this is a necessity to follow these tax rules so that you can get all the benefits and then give towards the causes that you care about. Because like a lot of you guys, especially me, I don't think the government uses our taxes very wisely. I'd rather have them use it for a million other things than what they're currently using it for, or currently or historically have been using it for. I don't want to fund other people's wars. I don't want to defend other people's countries. I want to do what's right for our citizens first and foremost. I want to take care of our people. The government doesn't do that with our taxes. Then it's immoral for me to pay more taxes to fund wars I don't care about, even as a veteran, to fund wars I don't care about when we should be just protecting our people first and foremost. That's more important to me. If the government doesn't do that with my taxes, it's immoral for me to give them extra tax money than I legally need to, right? I'll pay every fair tax dollar I have to, but it's immoral for me to give them tax dollars to support causes I don't care about when I can utilize that money to actually directly support the causes that I care about, which is protecting our people in our own country first and foremost. Tangent over. This is why it's so important that you understand this stuff, though. Said bonus advantages, right? We talked about the paying no money on the cash flow you're generating from your properties. We talked about being able to accelerate even more depreciation, offset all of your income sources, right? Offset all the tax from all your income sources. We talked about depreciation is one part of the puzzle. You get mortgage interest, which is deductible. You get those closing costs that are deductible, renovation costs that are deductible. You get all of these benefits during this entire journey. And then when it comes to pay taxes to extract some of your equity, you can borrow against your assets, pay no taxes. You can sell a property through a 1031 exchange and buy more assets and get even more benefits from those assets and pay no taxes. Or combine the two, pull some of the money out tax-free and then take the leftover, like I gave in that example, to be able to buy another asset through the 1031 exchange, get 100% of your money out, the profit, some of it 100% tax-free through the cash out refinance, some of it through 1031 exchanging into another asset. There's so many freaking benefits. And for those of you guys who are living in your house, if you're living in a home that you've lived in for at least 2 years, actually you could even for less than 2 years, it's not amortized. It's I can't think of the word. Whatever. It's like a ratio based on, if you only lived in it for a year instead of 2, you don't get the full benefits, you get half. If you live in it for at least 2 years, you get the full tax benefits. But if you live in your house and you sell your house for a gain, you live in it, you bought it for $300,000, 2 years later, you sell it for $500,000. Well, as your primary residence, as where you live, so not a rental investment, but as where you live, you can sell it, get that $200,000 completely tax-free. So those capital gains associated with the sale are completely tax-free for individuals, right? If you're a single individual person, $250,000 of tax benefits, $500,000 tax-free tax benefits if you're a married couple. That's just an extra bonus to understand for the house that you live in. We've basically done that every couple of years as well. We've house hacked and then sell them before we lose those benefits. It's like, as long as you lived in it in 2 of the last 5 years, you get the full benefits. When I was active duty, it was 2 of the last 10 years or something along those lines. So a lot of the properties that we lived in for at least a year we sold for major tax benefits if they appreciate in value. The first property I bought and sold for double its value 2 years later, first to free up my VA loan, second to get almost $200,000 tax-free pulled out to utilize however I want. It was through that, the capital gains tax exemption. These are just benefits that stack on top of everything else, but it's understanding all of it and incorporating it as necessary, whether it's your primary residence, whether it's you're buying a rental, and understanding the cash flow, why the $100,000 you make from cash flow is $100,000 you get to keep, how you get to offset your other income sources, how you get to continue pulling money out of those assets, all of that stuff. One thing I want to highlight is kind of my journey and what I will be doing with I don't know, millions of dollars of equity, over $10 million of equity I'll be building over the next decade. I guess we're halfway to that. We're already halfway to that goal because I'm already 5-6 years into my investing journey. But, you know, the $10+ million of equity that I'll have, I'm actually going to, like I said, pull out as much money as I can through cash out refinances, all tax-free. I'm going to then sell the rest for profit, right? For profit, but I'm going to 1031 exchange the hundreds of houses into a small handful of larger multifamily properties that I'm going to own a lot of equity in, right? So I'm going to buy those properties. And if I have excess equity in those deals, right? If I have too much money left over still and excess equity, I'm going to cash out refinance those further. So I'm going to make a bunch of money tax-free by taking out loans against the assets before I then 1031 exchange them into a small, like 3 to 5 much larger assets, own those with a lot of equity. Those are going to produce the same, if not more income than the hundreds of houses. And I'm going to get all the benefits from those, I'm going to reset all the tax benefits, all that good stuff. And I'm going to get whatever money was there, taxed or cashed out as well. Basically, more tax-free income. Maybe it's a little convoluted to understand, but not only am I making a ton of money through cash flow and paying no tax on it, and have been able to offset all of my other active income sources as a real estate professional status, but the exit, I'm going to tap into $10+ million of equity to consolidate my portfolio and pull out tons of money tax-free. And I'll probably end up lending a lot of that stuff to other investors. That's kind of the ultimate goal for most investors, is to just be a lender instead of the one borrowing money, like capital raising, being the lender and getting some outside returns. You have to be knowledgeable, understand the risk, all that other stuff. Cool. Speaking of lending, here's a pro tip. A lot of people have self-directed IRAs or 401ks, and they think what they should be doing is buying real estate with that. You could do that. You could do that, but those accounts typically are already tax advantaged. So here's what most people get it wrong. They try to buy real estate inside of those retirement accounts, but that kills the tax benefits. If the retirement account already has tax benefits, what is the benefit of the tax benefits that you get from real estate then? You're just kind of losing those tax benefits. You still get it because of the retirement account, but you're not getting the extra benefit that you would if these were not in retirement accounts, because it's already tax advantaged. So real estate investing, right, it slightly loses its edge in those scenarios. Instead, I recommend you buy real estate through your either your personal or your business names or your LLCs, right? Not really your personal name, but unless you're like house hacking, but through your LLCs, because then you get the full benefit of taxes there. And then use your retirement accounts to lend money, because that's taxed differently than owning assets, right? Lending income is taxed differently. Or investing in stocks, because that doesn't have those tax benefits. So whatever has not favorable tax treatment, maybe that's a good use for your retirement accounts. There is the case where you would say, hey, you know what, even without the tax benefits, it's still worth owning assets in there. And that's true, because you're going to get the benefits from the appreciation and all that other stuff. And you can sell it without having to worry about 1031 exchanging or any of that stuff. But if you want to think of it simply, I like to buy real estate in non-tax advantaged accounts, so like non-retirement accounts, and then use retirement accounts to lend money or invest in stocks, because those don't have as favorable tax treatments. In my opinion, it just makes the most sense, if you understand this stuff, to match your investment strategy, or match the strategy to the vehicle that you're using, where the funds are coming from, retirement accounts or regular, your regular funds or capital raising, whatever. Match that to the asset that you're investing in the tax association with that. That's really how you win. So remember this, real estate is not just about making money. It's really about keeping it. If you make $100,000 to real estate, you get to keep $100,000. On top of that, you probably get to offset lots of your other income sources. And you just get that tax-free growth over a long period of time. Stocks, $100,000 becomes 80 something to 90, $80 to $90,000 that you get to take home. If you're a job, $100,000 quickly becomes $83,000, $85,000, whatever. It's not one for one. In real estate, you make $100,000, you keep $100,000, if not even more than that, because the extra losses that you get to offset other sources. If you understand this, it's not just about what you make, it's about what you keep. You stop chasing income and you start building real wealth. You start building real wealth and build your financial freedom so that you can achieve your goals. You can live off your cash flow in a much quicker, shorter, faster time period than if you try to invest in the wrong assets or didn't understand these tax advantages for you. This is the big difference. It's not just about making money. It's about how much of it you're actually keeping, because that's what you get to actually use. So you get to actually build your other investments or live off of whatever you want to do. Not what you make, what you keep. Obviously, making more is always the goal, but not if you are making more. You'd have to make like $130,000, $140,000 in a job to match what you're making from $100,000 in real estate. So you can make less through real estate and keep the same, if not more, than making more through a job or through taxes. That'd be a good comparison to show you guys what that looks like. It depends on a lot of factors, but with all that, I really need you guys. Oh, I'm going to answer some of the questions here, which is great. I appreciate it, because this is the foundational training. Right? I went through it. I want to redo it by clarifying, answering more of your guys' questions if I missed some key topics, and then putting some visualizations, some slides to accompany a lot of this stuff. I prefer to train people, to educate, where you can visually see the things that we're talking about. You can hear the things that we're talking about, because I think most people learn better that way, especially if you can not just hear or see the concept, but like see how it actually is done. Like the example for depreciation, see how that process looks so you can do it for yourself in the future. And I could build an easy spread. We already have a spreadsheet for that, but make that accessible for you guys. A lot of these tools. I need to know what you guys need, what's missing, what was too difficult, what was too advanced, what you'd like me to re-clarify, all that stuff, so I can answer some of this stuff for you. All right. Nick, if both spouses are full-time W-2, what's the best way to leverage cost seg and accelerated depreciation? It's going to be tough. It's going to be tough to do so, because if we just Google qualifications, we're just going to trust AI for a second, and I'll cross-check it with what I know for real estate professional status. I'm going to screen share this for you guys. There's literally nothing wrong with you Googling something right away to get some general understanding, but don't just trust ChatGPT or Google immediately. Talk to your real estate professionals, which is not me. I'm not a real estate professional. Talk to your legal and tax professionals, right? I am a real estate professional, but that doesn't mean I'm your CPA, right? I don't give you tax advice. I'm not your attorney. I don't give you legal advice. I'm not any of that. Talk to your CPA, talk to your attorney for your specific scenario, right? That's the best thing I could say. I'm not your attorney. I'm just going to give you a general understanding right now. So let's screen share real fast. And you guys can see how we're going to do this. All I know is qualification for real estate professional status. To meet this with the IRS, you must meet 2 tests annually. Spend over 750 hours in real property trades or businesses. And real property, that has a definition, right? It explains quickly. There's an explanation of what that actually means. It's real estate related, real property trades and businesses. And dedicate more than 50% of your total working time in those activities. Additionally, you must materially participate in your real estate activities, often by working over 500 hours in them. Well, that's basically the same thing here. This is saying, even though you're a real estate agent, you're not a real estate professional per se, unless you're also working in assets, which just means you have to own properties to get these benefits. That's what it really is saying. You have to own, if you're just a real estate agent, you could, in theory, qualify as a real estate professional status, but there's no passive losses to offset. You're just getting your business, your entrepreneur or business owner losses, whatever the Schedule C, I think, on your tax return. All right. During the tax year in real property trade, so development, construction, rental, management, whatever, just things that you're doing for real estate, and 50% of your time must be dedicated towards this. You must own at least 5% of the real estate business. So like these are all the things, right? Like these are qualifications for you. Talk to your spouse. spouse rule. Only the hours of the spouse who holds a status are counted for the 750-hour test, though both spouses may materially participate, hours are combined. Does that make sense? Only the hours the spouse who holds the status are counted for the 750-hour, though. So you might both meet the material participation, but the spouse needs to hit the 750 hours, and you could both benefit from that. Right here. W-2, real estate work done as a W-2 employee does not count towards that. So if your W-2 is that, it doesn't count. That's a big one. And this is the big one. The 50% test makes it difficult for those with full-time non-real estate jobs to qualify. So this is what I mean. You might have the right number of hours between you or your spouse to qualify, but that's highly audited because it's hard for someone to maintain full-time employment and 750 hours. How do we think of work hours? So per week, so 750 divided by 52. That's basically saying 14 hours a week are dedicated towards real estate, right? You're working 40 hours for a job and there's 14 hours a week for real estate to meet the minimum qualifications. Well, if you're doing 40 hours at a job times 52, and I know it's a little off because you're not working per se every single week through the year. I think it's like 48 weeks you're typically working. Your job is 2,080 hours. So you'd have to work 2,081 hours, even to get the qualifications, to say 51% of your time is dedicated towards real estate professional to meet that qualification. It is virtually impossible to do so, to work 40 hours in real estate, 8 hours a day, 5 days a week, plus 40 hours in your job. Well, you know, a little bit more for real estate, but 40 hours in your job, 8 hours a day, 5 days a week, right? You might say, oh, weekends and this and that, whatever, but that is the most highly scrutinized. Those who have full-time W-2s and are claiming real estate professional status, that's why it's almost always best to do it with a spouse, or understand that you're going to get these tax benefits. And if you have a spouse, they can qualify, or you might have to lower the amount of time that you're spending in your W-2 if and when it starts making sense. Don't do that initially. Don't let the tax benefits wag your real estate investing journey decisions, or, you know, quit my job to go all in real estate. That's a major benefit. And it made a lot of sense with my wife quitting her W-2, but I made over 6 figures. So it didn't make sense for me to quit my W-2 to be a real estate professional status, but it made sense for my wife making, you know, a couple grand a month, which we would get back from real estate benefits, the real estate professional status benefits, the tax benefits. It made a lot of sense for her to do it, but it depends on where you're at in your income and where you're at in your real estate journey for it to make a lot of sense. Usually it's going to make more sense if you have a lot more income. And then as you do more real estate, you're going to end up in owning more real estate. You're probably going to make more income doing real estate activities. For example, I can only I know I say only, and I understand that's difficult for most people to even fathom, but I can only comfortably buy 2 to 3 properties a month, not a year, not every 6 months, a month. I can buy 2 to 3 properties a month, but I have the opportunity to buy dozens of deals every single month. So what do? Instead of keeping all those properties, I'm analyzing a variety of deals. We're choosing the 2 or 3 we're going to move forward with, and then we are selling those to other investors for them to buy, and we're making active income through that. Well, that active income through real estate, right, just natural part of our business, is completely tax-free because of the rental holdings loss and the real estate professional status. There's other ways that you continue making active income through real estate, right, that then are further offset. It doesn't make sense to quit your job to maintain real estate professional status if you guys are both making high income and you don't have either you're both making high income or you don't have enough tax benefits coming from real estate that would actually provide you that benefit, right? It's like a math equation. How much money would you save if you did this, if you were real estate professional status, versus how much money are you making in your W-2? That's really the math equation. Which one's better? And then if it's close, well, wouldn't you rather, at least for me and my family, it made way more sense to have my wife at home more frequently, to work in the real estate business from home as her schedule allowed her to meet these qualifications, while also raising our family, starting and raising our family. That made way more sense for us personally. That may or may not make sense for you. I can't tell you that. Talk to your CPA for the math side, and then you make the decision on if that is worthwhile for you or not. Can co-living qualify for short-term rental loophole, or do we need to buy a true short-term rental? Yeah, no. Co-living does not qualify for the short-term rental loophole because short-term rental, these are good things because I'll include more qualifications for this. It'll be easier if you can visually see it. Tax loophole. Well, it went AI mode on me. All right, let's show that. So the hours are much lower, which is great. But the thing is, it has to meet. Wait, why are we talking Augusta rule? That's a whole other thing, which is you can rent your property out to yourself and not pay taxes. That's a whole other. I didn't even mention that. There's so many tax benefits to real estate. It's depending on how you look at it, it's almost disgusting, but it's also very beneficial because that means, like I said, less money to the government, which means I can utilize that for the things I care about more. The 7-day rule is the big reason why you can't, right? Not the hours, which make it way easier, but the 7-day rule. Your average stay for your tenants must be 7 days or less. If your co-living is doing that, rent by the room is doing that, that is way worse. So the 7-day rule is why only short-term rentals really qualify for that. Some people make the case for RV parks as well. As long as people are there for less than 7 days, it's a similar thing, but it's a way harder asset, more costly, and way more difficult, right? Now you qualify for the 7-day rule, but it's harder to materially participate and be the primary manager of that asset, right? That's a big part. It's not spend at least 100 hours on activity and more than any other person, cleaners, property managers, or whatever. That's why I say managing it is typically the easiest way. And more than 500 hours on the business annually. Well, it's really hard to spend more time at an RV park than any of your employees. That's why that doesn't really work for RV parks. And for short-term rentals, this is why this works well, because you can do this through a decent amount of automations, and the 7-day rule, right, is what qualifies the short-term rental tax loophole. It's one of the biggest things is this. Well, you got to do both, right? But this, why you can't do it with co-living, long-term rentals, or whatever. Why? I don't even fully understand why they made this the case. They probably explain it for some reason, but yeah, there's probably a reason behind that. Cool. So hopefully that explains that. One thing I learned last year is that you have to put your feelings aside and thoughts about how these laws are unfair for the working class and learn. This is literally is what I was talking about. Like, if I actually care about the working class, if I actually care about the causes that I care about, the best thing I can do is not ignorantly give more of my money to the government for them to misappropriate when I can utilize those tax savings and utilize it towards things that I actually do care about. So if you care about people, you care about cause. That's why I provide 95% of the trainings that I do, 95% of the education, the tools, the resources, all for free. That's why I guide the majority of people that want to work with me at a higher level to either my low-cost co-living freedom community or have to filter people down from, like, if they want to do super investors, and I say, hey, go through the lower cost free stuff first. This makes more sense for you because these are the things I care about. I care about helping you guys on your investing journey. And a big part of that as well is not only am I making solid money from my real estate, obviously, but I'm also keeping the majority of that money as well. So I don't have to worry about money. So it's different, right? If you don't have your cup full, if you're scrambling, if you're a paycheck to paycheck or barely making enough to make ends meet, you can't really donate much of anything to your causes. You can donate some time, but the best thing that you should do is learn how to make more income, save more of the income, and then donate time and or money right? There you go, to the causes that you care about. And there's a third benefit, which is influence. So like, I can go feed a homeless person or make 10 sandwiches, or I can lead an event where 10 other people are also making 10 sandwiches. And now my one impact of helping 10 people now helps 100 people through the influence benefit. My mentor, Pace Morby, taught me that when I thought about retiring in 2024, because I already had more than enough money coming in through real estate at that point. I quit my job at that point and said, okay, well, there's really no reason to do this. Let me focus on my family and all that stuff, take that extra time, put a little bit more towards real estate and educating other people. And then the majority of it going to my family. And I'm thankful for that. He taught me that lesson. If I care about my causes, I can donate my time. I can go clean up a single beach myself. I can go feed 10 homeless people. I can whatever, or I can earn more income, donate to the causes that really work really well for that. Like Stop Soldier Suicide is a big one for me. You can donate to those causes and create influence. When we host 200 person meetup and I'm not charging anyone anything, I'm getting sponsors to cover all the food and all that. Plus all that I'm asking them to do is donate toys for Tots, donate food to the food bank, donate money towards Stop Soldier Suicide, doing those kinds of things. So the influence, that is a way bigger impact. And that's possible because I make more than I need, A, It's hard to fill up other people's cup when yours is not full or it's empty, right? Especially if it's empty. If you're scrambling to fill your shit up at the end of each month, it's a very difficult place to be in. How do I know? Because that was literally the majority of my life, the entirety of my childhood until my early teens. And then as I went to college and worked multiple jobs and had no financial support, no resources from anyone else, it was back to my life from 0 to 12, and then from 18 to 23. And then I got my first big boy engineering job, and then I cut my pay in half to go serve our country. So, maybe I like living like that. I don't know. Thankfully, real estate changed a lot of that trajectory. So I don't even know where I was going with that, but hopefully that makes sense, right? Well, and government pays insane taxes, not anymore. Absolutely, Stacy. Absolutely. It sounds like you're the real estate professional that's going to help offset the taxes that your husband and you have to pay, right? Because as a married couple, you're paying taxes collectively. We're offsetting your guys' household taxes. That is already income, right? Money saved is money earned, right? It's not about the income. It's about what you get at the end of the day, the profit. So if you're saving money, that's a very efficient way to accomplish that. Cool, y'all. I don't think there's anything else from Instagram. My Instagram guys are always slower. Cool. All right. With all that, I'm going to regroup this training, organize it a little bit better, turn into an actual presentation with slides and all that, examples, a little tool here and there, some references to things so you can learn more about certain concepts. But if you have any more questions, clarification, whatever, go to the free Real Estate Freedom Roadmap community that I have, where I host these trainings and post these kinds of things as well. And then we'll include the replay with all the other resources and all that. And you can even further, in the recent post that I made, even further ask me more clarification so that I can incorporate it in the final training for you guys. But like the more built out training for you guys, not me freestyling it with a little bit of a outline. Cool. And if you want tons of free real estate tools, trainings, all that other stuff, and a community of over 2,000 other investors, buyers, wholesalers, bird dogs, capital partners, all that kind of stuff, all there, it's in the Real Estate Freedom Roadmap community. You can get all that. It's absolutely free for you guys. All right. Enjoy. And that's where I host my challenges. I do a lot of free challenges, whether it's my super investor strategy or the co-living challenges. Go ahead and join that. And then you'll be notified anytime I'm doing more trainings, those webinars, those trainings, whatever that I do, you'll be the first to know. All right, y'all. Thank you and have an excellent week.